This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
What did I say a few weeks ago? That the stock market is never obvious. It's designed to fool most of the people, most of the time. The overwhelming consensus has been a soft economic landing with lower interest rates and lower inflation. This week's hot January CPI print fooled a lot of people. A lot of people were positioned the wrong way. So the question remains, is the data just a dash of cold water or the beginning of a deeper freeze? Up next, let's discuss. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. So I'll say that quote again. The stock market is never obvious. It's designed to fool most of the people, most of the time. That's from the famed trader Jesse Livermore. I keep saying that quote because it just seems when everyone is saying something is going to happen, we often get something different. Earlier this week, we had a pretty darn big downdraft. Now, we did rebound a bit at the end of the week, which is good, but still, 500-plus point down day for the stock market. And what's amazing, it was the widest sell-off day, according to FactSet, in over a year. The number of decliners swamped the number of advancers by 11-1. I will get, in a little bit, a few minutes, I'll speak to sort of the why behind that, what the catalyst might have been for the big downdraft. But it was hardly surprising. Because we had, a 20% plus rally over the preceding 72 days. Keep this in mind. It took 757 days for the S&P to go from 4,800 to 4,900. So over 2 years to move 100 points. And just 15 days to go from 4,900 to 5,000. And I think the S&P had closed positively 14 out of the 15 prior weeks. Last time that happened, last time we had a rally that strong in such a short period of time in terms of consecutive number of S&P improvements, well, according to Charlie Bolello, it was back in 1972. And what happened then is that the S&P actually went sideways for the next 7 months before eventually going higher. We'll see what happens this time around, but it wouldn't surprise me at all if the market cooled for a little bit, or at least we saw a little bit of steam come out of the balloon, and I think that's what we started to see maybe this week. At the very least, we're positioned for surprises to the downside. Whenever you have the consensus so uniformly in one direction, any sort of data that suggests something else could happen, there just isn't a lot of protection on the downside. It reminds me of the famous trader Bob Farrell. I've been following his work for years, and he has kind of 10 rules of trading that he always used to espouse, and I keep them in my desk. I'm not going to go through all 10, but there are a few that tend to be, I think, pretty applicable to the current environment. One is that markets tend to return to the mean over time. Whenever stocks get extended in one direction or another relative to their long-term average, strong uptrend, a strong downtrend, you often see prices revert. Now, again, the important thing is here that the trend line is up and to the right, okay? So it's not like the markets have to give up all their gains and go back to a flat line. But when they get overextended, we often see a counter move. Relatedly, number 2, excesses in one direction will lead to an opposite excess in the other direction. We certainly saw this, back, think of the dot-com bubble, right? We had the NASDAQ bubble in 1999. What he calls the percent price oscillator moved above 40%, which is a measure of extreme optimism. Guess what? That was all given up and then some in the plunge in 2000 through 2001. And the third that I think is appropriate for today's conversation and today's market is that there are no new eras. Excesses are never permanent. So whenever we hear about a new technology, whether it was the cell phone or the internet or electric cars or whatever it is, we often see a burst of speculative activity, speculative fervor. His point is that we've seen it. Of course, the actual specifics are different each time, but the phenomenon is the same. And that those things do not last. What's the phenomenon today, of course? AI and anything related to artificial intelligence. So I bring all this up because I do think we've seen some extreme behavior in the markets over the course of really most of the last year, but even more so, I think, just here in the last couple months. And I'll pick on one stock, NVIDIA. Everybody knows about NVIDIA. It's now the third largest company in the world by market capitalization, symbol NVDA. It's not a stock that we've bought at the portfolio level. I do own it personally, just a little bit. I don't have a lot, but just have a little bit in my own account, so you can judge for yourself whether this represents a conflict of interest or not. But it's less about NVIDIA itself and more about NVIDIA, the concept. Because NVIDIA now trades about 60% above its 200-day moving average. That's about extreme a reading of short-term positive momentum as you'll ever see. Get this. Their market capitalization as of about a week ago, I think it's even a little higher today, but as of about a week ago, according to Charlie Bolello, is $200 billion more than the entirety of the S&P 500 energy sector. So pick an energy stock, Exxon, Chevron, BP, Occidental, add them all together. NVIDIA has a market cap $200 billion more than that. And by the way, NVIDIA now has a market cap greater than the entirety of the China stock market, which is the second largest economy in the world. I mean, think about that for a second. Okay? Stock now trades at over 40 times sales, over 95 times earnings. So not only is the market pricing in astronomical growth rates going forward, but also that they're going to be able to maintain their dominant market share, 90+% market share, that no competitors are going to come in and maybe undercut them on price because the market's probably also pricing in 70 to 75% plus gross margins. And again, I bring all this up not because I'm picking on NVIDIA. I'm not saying NVIDIA is a good investment or a bad investment. NVIDIA may end up justifying the current valuation, given how big of a field and a marketplace AI could actually end up being. Okay, so I'm not really making a judgment call on NVIDIA. I'm just making the point that you have an excess exuberance surrounding the stock to the extent where the bar is incredibly high. The market is extrapolating years and years of incredible growth into the current valuation. Now, I would just say in a more general standpoint, if you look at the quote-unquote Magnificent Seven, we've talked about that collection of large, or I'll say mega-cap tech stocks. If you look at them together, according to Goldman Sachs Global Investment Research, consensus expectations are calling for those 7 companies to have a compounded annual growth rate going out to 2026, so for the next 3 years, I should say, about 4 times the rate of the other 493 stocks in the S&P 500. Specifically, about a 12% compounded growth rate for those 7, about just under 3% for the other 493 stocks. So I'm not going to sit here and tell you it won't happen or it can't happen. These stocks have had outsized, of course, earnings and revenue growth and have pristine balance sheets for the most part, but that is a very high bar going forward. Meanwhile, of course, Wall Street's responded and investors have responded, and I think what you have to be a bit wary of, again, along the lines of kind of thinking about excesses in the market, you have to look at how concentrated some of these sort of market investments like exchange-traded funds are in these names. So I actually looked at, I'm not going to name specific names, but I looked at 7 or 8 of the most widely held, most widely traded large cap growth ETFs, exchange-traded funds, owned by a lot of institutions, owned by a lot of individuals, and owned by a lot of 401ks as well. Well, just the ones I selected, the 10 largest weightings in their ETFs range from 55% of the portfolio down to about 47% of the portfolio. And by the way, all of these have over 200 holdings, but just 10 out of those 200 make up, on average, about 50% of the weight. So essentially, as those 7 go, that's how those funds are going to go. And I think it's important to think about this because, I met with a potential client about a week ago who had a number of different mutual funds at different firms. And he was sort of operating under the assumption that he was diversified. But if you looked at the actual holdings and these funds and ETFs that he had, again, at multiple places with multiple advisors, he basically had the same stuff in every account and the same weightings. He was essentially concentrated in 5, 6, or 7 companies. which, of course, over the last year has not been a bad idea. It's been a supremely good idea. But it's hard to believe that these excesses will last indefinitely. And you can also look at this relationship between sort of growth and value. We are reaching historical levels of value underperforming growth. In fact, on both a rolling one-year time frame and a rolling five-year time frame, according to the good folks at Strategas, value stocks are in the 5th percentile versus growth of outperformance. Read an interesting piece from, I think it was Natixis, I believe. Yeah, the mutual fund company. And they looked at sort of the historical track record when you've seen large swings between growth and value over the past few years. Because, of course, last 12 months has been all growth. The year before was really all value. Remember, 2022, a lot of these mega cap tech stocks were disasters. The NVDAs of the world, the Apples of the world, had a terrible year in 2022, and it was value names that did better. Of course, recently, like I said, the pendulum has gone back the other way. But what they did is they looked back, I think they went back to 1979, and they looked at extreme periods of growth outperformance. So they had one that ended in August of 2020, which of course was the run-up to the tech bubble popping. Another one that ran till November of 1980, November of 2009, December of 91, and of course recently they measured it up to December of 2023. Each of those periods saw significant growth outperformance. Well, in all 6 of those periods, well, I should say 5 because this one has not been determined, but in the past 5, 1 year later, value was up by a double-digit percentage versus growth. So, again, history doesn't repeat itself. I'm not saying that past performance is indicative of future returns. Just making the point that when you get this type of excess, whether it's at the individual stock level or the sector level or even the overall market level, you often see corrections and some mean reversion going in the other direction. And just to further put a kind of an explanation point on this, I saw from FactSet that if you look at the S&P 1500, which is a pretty broad index, it includes the S&P 500 plus mid caps and some small caps, covers about 90% of the market capitalization of U.S. stocks. If you look at that index and then look within that index, you'll find that since the Fed started raising rates, which was the first rate hike was March of 2022. So basically 2 years, over the last 2 years, 53% of the S&P 1500 has lost money. More than half of the stocks in that index have had a negative return over the past 2 years. Meanwhile, the overall index is up a healthy amount. All this being said, remember what I said a couple weeks ago, that just because we have excesses in the market and we could have some mean reversion in the market does not necessarily mean I am negative on the market. It just means that maybe leadership comes from different places, that maybe value starts to do a little bit better on a relative basis. Because remember what I said, nothing is more bullish than all-time highs. A lot of people think that when you get to an all-time high, which is where we are today, remember, we just broke past the highs set 2 years ago in January of 2022. A lot of people think that when you hit an all-time high, the next move has to be down, that it's a negative signal. Well, the historical record suggests the opposite, that highs generally beget new highs. If you look at all the new highs set going back to the early 70s, okay, so what's that, 50 years. This is according to Michael Batnick up at Ritzold Asset Management. With the one exception of 2007, which of course was on the doorstep of the great financial crisis, the worst sell-off in 75 years. With the exception of that new high, returns were higher 1 year later 100% of the time. Okay? And again, past performance is no guarantee of future results, but the historical record suggests that new highs are not to be feared. I quoted some data a couple weeks ago from JP Morgan. I'll just reiterate that data. They looked at all the cumulative S&P 500 total returns from January 1 of 1988 through today. And I think today was about 2 weeks ago. And what they found is if you measure the performance, cumulative performance, whether you invested at all-time highs since 1988 or just on any other day, on other days that weren't all-time highs, the returns are almost the same. So over 5 years, if you invested at the all-time highs, your cumulative return was on average 78.9%. If you invested on any other day besides a high, it was 71.4. So actually, your returns were slightly better if you invested on the highs. So you can read what you want into that data. I'm sure somebody can produce some data that's less convincing than that. But I guess the bottom line is, even with everything that I'm saying, I think we're more likely to see corrections, rotation in the market away from things that are overpriced rather than a collapse in the market over the next 12 months. We'll see. Of course, anything can happen. But I think it is important to make sure that we focus on historical precedent. I think it can give us some visibility into the future. So what else is going on? Well, I mentioned at the top that we had a really big downdraft earlier this week, a 500-point drop on the Dow and almost a 1.5% drop in the S&P 500. So what was the catalyst for that? And I mentioned in the sort of intro to the show, was there just a dash of cold water, or are we in line for a deeper freeze? Well, what was I referring to? The dash of cold water was the fact that the CPI print, the Consumer Price Index print for January, was hotter than just about anybody thought. So if you look at headline inflation, it came in at 0.3% month over month versus 0.2% estimate. If you look at core inflation, which backs out food and energy, it was up 0.4% month over month versus the 0.3% estimate. A lot of people thought that the headline inflation would come down under 3%, but it did not. Ended up at 3.1%. But if you do dig a little bit deeper, which is something that I like to do, I think you get a slightly more positive story there, and I think that's why the market probably picked up in the couple trading days after that negative day for the market, because more than half of the inflation in January came from shelter, housing, both housing prices and rental prices. More than half. In fact, shelter consumer price index increased the most in 11 months. But what's really interesting about this is you've got to look at the lag factor, okay? The official rent and what they call owner's equivalent rent, which are the main sub-buckets within the shelter category, they generally lag market trends, current market trends, by almost a year. So the reality is rents have been coming down about 7 months, for the last 7 months or so, and have been negative year over year. But that has not been reflected in the actual official data that gets calculated into CPI. So I'm not sitting here being sort of Pollyannish with respect to inflation and saying that it can't resume higher at some point. There are some risks to that, but I am making the point that the likelihood is that shelter will actually act to bring inflation down here, I think, over the second half of this year. So hopefully people aren't as wrong-footed as maybe earlier this week suggested. But definitely the consensus was that inflation was going to come straight down and the Fed was going to be cutting rates come March, April, May. I think that's all been pushed back. I think people are realizing that inflation is not as linear as we think. It's going to be a lot bumpier. It's going to be a more circuitous path. And that the Fed probably will still raise rates, but maybe sometime over the summer or the fall. I don't think that changes the prognosis for the markets all that much. In fact, I would say a slower rate cutting path is actually a desirable outcome. I mean, people say they want lower rate cuts. I personally would not want to see the Fed slashing rates because that would probably reflect significant concern about the health of the economy. Almost an emergency situation. I don't think we want that. I looked at some data from Ned Davis Research. I followed his work for a long, long time. He suggests if you go back to all the rate cut cycles post-World War II, he suggests that the S&P 500 has risen an average of 24% during the first year of a slow easing cycle. And by slow easing cycle, he means less than 5 cuts over a 12-month period, versus only 5% increase during fast cycles, 5 or more cuts. So currently the market's pricing in 3 to 4 cuts over the next 6 to 12 months. That would kind of be in keeping with what Ned Davis is saying. So we'll see. As far as the economy goes in general, I don't have a whole lot to say. I talked a couple weeks ago about how I think the economy is better than a lot of people think. The only further point I will make on that is you're seeing a lot of headlines about, well, not so much government debt. We all continue to read about government debt, but you're seeing increasing headlines reflecting personal debt, credit card debt. I think the key takeaway there is a lot of the headlines that we're getting are nominal figures. In other words, they're figures in isolation. They're not relative to inflation, and they're not relative to incomes, which I think is a big mistake because personal incomes have gone up over 20% since 2019. So you can't just look at the absolute figures. The reality is, I read a piece from Oxford Economics that household debt relative to income is actually about the same, actually slightly lower than it was pre-pandemic. So going all the way back to 2019, bottom line is consumers are no more stretched today than they were then. And you get a similar reading if you look at credit card debt. Of course, at the household debt level, mortgages are almost 2/3 of that. Out of those people who have a mortgage, I've read that over 80% of the people that have a mortgage today, I think this is according to the New York Fed, 80% have a mortgage at less than 4%. Okay? So when you consider that rental prices are coming down, which is more people, particularly the bottom half of the population, tend to be more sensitive to rental prices than housing prices. Incomes have increased over 20%. I'm not saying that everything is rosy, but I am saying that on a relative basis, we are not seeing a significant increase in indebtedness, delinquencies, anything else that makes me think this is the next, 2008. So just keep that in mind going forward. I don't want to talk too much about the macroeconomy today, but I thought I'd mention it given that those headlines are picking up. I did want to make sure that I left some room to give you the latest on what I'm hearing from some of our top holdings. Of course, we're in the later stages of fourth quarter earnings reporting season. Stick with me. Back in a minute. I'll bring you a few highlights. The buy tech and high multiple growth stocks playbook of the past few years is no longer a winning strategy, but dividend payers are outperforming. Have you reviewed your portfolio to meet today's updated market conditions? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know about them. To learn more about how market leadership has shifted and to become a better informed wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
So as mentioned, I just want to bring you up to speed on what we're hearing from some of our top holdings here at the Wise Investor Group. As I always like to say, remember that if you are a client of ours and I mention the name that you hold, I think you can trust that we've done a lot of due diligence on the name and as well as your particular financial situation, and we feel confident that it's a suitable recommendation for you. If you are not a client, unfortunately, I can't manage your portfolio through the podcast, through the internet, so you really have to do your own homework. Make sure it's appropriate for you. Make sure that you understand the potential rewards, also the potential risks, and also all the names that I mentioned today are names that I own in my personal and my family's portfolios. You should decide for yourself whether that represents any conflict of interest on my part. So I'll mention ABBV, symbol ABBV, one of the larger pharmaceutical companies in the world. ABBV has responded well to their most recent earnings report. If you recall, kind of the knock on ABBV over the years has been their flagship drug, Humira, the anti-inflammatory drug, came off of patent, and that was at one point responsible, I think, for over 60% of their revenue. So ABBV's valuation multiple was dragged down into the single digits because people were kind of predicting sort of terminal revenues, from Humira. But what AbbVie has done in the last few years is not only have they been quite successful with their research and development, a lot of their early stage drugs are now starting to really take off in terms of marketability, but they've made a number of key acquisitions to diversify their revenues and their earning streams. And it looks like from their recent quarter that things are really on track. As far as the Humira goes, we all knew that they were going to lose sales, to generic competition. But the pace of erosion there has been less than what a lot of analysts feared a few years ago, and that was reaffirmed in the quarter. Their new flagship drugs, Skyrizi and Rinvoq, those are the new class of anti-inflammatories, very strong. In fact, for both of those, AbbVie guided 3 to 5 year revenues up over 20% from where analysts were previously. So there's a lot more visibility there than really just a few months ago. Remember, they took over the parent company of Botox. That's been a very slow business, certainly in COVID and the COVID hangover period, because a lot of people deferred cosmetic surgery, sort of discretionary surgery, if you will. That business looks like it's starting to do better. They give some pretty good guidance on the aesthetics business. And then the other thing I would just say is some of their recent acquisitions. They made $15 billion worth of acquisitions in about 2 weeks. Of course, we'll see the fruits of that more in the future because some of those were drugs that aren't even on the market yet. But I think people were really worried that it was going to significantly dilute their earnings. AbbVie maintained their earnings guidance for the next 12 months. So it looks like they feel very confident they're going to be able to integrate those acquisitions successfully. And stock's still reasonably priced. Still trading at 12 or 13 times earnings, discount to the pharmaceutical group as a whole, and of course a big discount to the S&P 500. I think the risk there, obviously there's always risk with pharmaceuticals in the sense that maybe their drugs don't they have the efficacy that they hope for. I also think there's a bit of government risk, right? Of course, this administration is trying to levy caps on drug prices. We still don't know exactly what that looks like and to what degree it'll affect AbbVie. So that's something that we'll pay attention to. I do think, though, even if there are caps implemented, they phase in over time. They don't even start, I think, till 2026, at least the first wave of those. But that is something that we'll be watching. So I think AbbVie still trades at a reasonable valuation. And remember, healthcare was one of the worst performing sectors in the S&P last year. Pharmaceuticals specifically. So it would not be a surprise if healthcare and farms had a bit of a catch-up here, particularly if the economy slows a bit and people are looking for more defensive plays. And, of course, a lot of the farms, including AbbVie, pay healthy dividends. Maybe the same could be said for Chevron and big oil. I realize a number of you listening are not fans of big oil and energy in general. I get that. But for those of you that have Chevron in your portfolios or don't have a problem with it, Chevron has been a poor performer over the last year. Energy, again, like healthcare, was one of the worst performing sectors last year. Chevron specifically had a double-digit negative return, lagged some of the other large integrated oil companies, oil and gas companies. But if you look at their most recent results, I think there are reasons for optimism. A few things kind of stood out to me in the quarter. One is just the valuation. They traded about a 10% free cash flow yield. Remember, the higher the free cash flow yield, the cheaper the stock is. That's versus a peer average of about 8%. So they screen a fair amount cheaper, almost 25% cheaper than their peer group, despite the fact that they have leading capital returns. So if you look at their return on invested capital, about 10% versus a peer group average of 8%. So this is a company with better balance sheet and profitability metrics with a cheaper valuation. I think there was some concern about their growth profile, but as their Tengiz, T-E-N-G-I-Z, as that field ramps up, Chevron commented in their quarter they expect upstream volume and cash flow to pick up significantly, and they're returning cash to shareholders. In 2023, they returned about $26 billion to shareholders, almost $15 billion through share buybacks, another $11 billion and change through dividends. They also increased their dividend by 8%. So this is a company that's reflecting good balance sheet strength, good capital discipline, good execution. The risks to Chevron, in my opinion, are macro risks, right? There's a lot of oil in the world. There's a glut of oil in the world, and that has kept crude prices pretty low. Remember, when Ukraine broke out, crude rolled up to about $120 a barrel. Now it's in the 70s. So if we were to see a real slip in crude oil prices, down under $70 a barrel, Chevron would still be profitable, but I don't think their metrics would look as good. So I think that's the risk. That's a risk. It's more of a macroeconomic risk. But on an individual company basis relative to their peer group, I think Chevron is interesting and maybe worth your consideration. Just a couple others I wanted to get to briefly. One is we actually, in some of our equity income portfolios, added a new name in portfolios where it was appropriate, and that is the spinoff of Johnson & Johnson, KenVue. Okay, now KenVue is their, as you may recall, is their consumer health division that Johnson & Johnson spun off last year. About 40% of the sales are self-care, 30% skin health and beauty, and then 30% essential health. And I think you know a lot of the products, right? I mean, household names. Tylenol is the number one doctor-recommended pain medication. Neutrogena, number one recommended sunscreen and acne brand. Listerine, number one recommended mouthwash. Nicorette, number one recommended smoking cessation product. So they have some of the best-known consumer products in the world. And I think the positive on KenVue, there's several positives. One is that their product mix is skewed generally towards higher growth categories. I don't know if you have teenage girls. I have 3. The amount of spending that we do on skin health and beauty is astronomical. And that is one of the fastest growing categories in all of consumer spending. And they have a really good product mix there. They also tend to have geographic exposures that are more concentrated in higher growth regions compared to a lot of their peers, and in regions and in categories where there's less generic competition. So they're less likely to get undercut by generic names like you see with companies in the toilet paper business or the paper towel business or other types of consumer products. Now, granted, their execution in the last year has not been good. When it was spun out of Johnson & Johnson, I want to say KenVue was trading around $28, $29 a share. Now it's at 19 and change, so it's done poorly. A lot of things going on there. They had severe supply chain disruptions that really resulted in a pretty significant loss of distribution in some key product lines. It hurt their margins, product recalls. I mean, a lot of things. It was just sort of almost a lost year for them. However, in looking at their most recent quarter, they pointed, and a number of analysts that I've read have pointed to better execution going forward. I read a really good report from JP Morgan that was very positive on what they had to say. And I think the valuation is now pretty attractive. Not only do they pay a 4.2% dividend, they're trading at less than 16 times earnings. If you look at any of the large consumer staples companies, not too many of them are trading at less than 16 times earnings, and that's where KenVue trades. So yes, there's some lumps. I think if you're looking at the risk side of it, it's really their operations. Can they return in the second half of this year to the type of growth metrics that they've generally were able to produce when they were under the Johnson & Johnson umbrella? That's the risk. I don't think there's a huge economic risk because people tend to buy their products regardless of sort of the macroeconomic backdrop, but there's certainly a company-specific execution risk. So that's what we're going to be watching, but with the valuation and the dividend, there might be some support there. By the way, just to backtrack a bit, I want to give credit to Goldman Sachs for some of their work on those Chevron numbers, and the ABBV numbers I quoted came from Raymond James, our analyst here, who had a really nice write-up there. Just wanted to mention one more, and that's Amazon. You all know Amazon, symbol AMZN. Amazon, of course, is one of the Magnificent Seven. They're in that basket, had a really good year last year. But if you look at Amazon over the course of the last few years, they actually have not been a great performer. They've been a laggard. They've actually underperformed the S&P over the last 3 years, and I don't have all the math in front of me, but I think they've been the worst performing out of those large tech stocks. And there have been a lot of reasons for that. Certainly a COVID hangover, I think, is a big part of that, right? So When COVID ramped up and we were all sitting at home ordering Amazon packages, guess what happened? They had to hire 100,000 people. They had to build new warehouses. They bought planes. They bought procurement centers. They had to spend a ton of money. And then a lot of that demand, I won't say it evaporated, but it went back to the malls and, people going out and about. So they were left with really lousy margin profile on the retail side. And then on the Amazon web side, which is their real growth engine, they lost some market share to Google and Microsoft, and maybe were a step behind there in sort of the whole AI-related cloud storage business. Well, if you look at their recent quarter, there is a lot of reason to believe that they may have turned the corner. For one, we finally saw the AWS acceleration that a lot of people had hoped for. Significant acceleration in year-over-year trends. And management indicated, again, this is according to a Raymond James report, as well as the conference call that I listened to, management indicated that would continue this year. So it does not appear that they are losing market share to their competitors. In fact, they may be picking up a little bit in market share. Secondly, they highlighted a really significant, almost a $50 billion opportunity in terms of annual run rate starting in the mid-2020s in digital ads, okay, on their digital streaming platforms, okay, like Prime Video. So they barely monetize that. They barely tap that. That's really a whole new field of growth for them. And then on the retail side, I thought it was really significant that retail and margins year over year expanded almost 6% with a significant decrease in unit costs. So, who knows if Amazon can continue growing at that rate. Of course, the knock on Amazon is it's a complicated business, right? And when parts of the business are doing well, other parts are not doing well. But I think there is the potential for Amazon to be a better performing stock on a relative basis than it has been. I think the other risk is just valuation. They trade at about 27 times earnings, this year's earnings, which isn't super expensive, but of course it's a premium to the S&P. And so if you do get, as I said at the top, if you see some steam come out of the Magnificent Seven balloon and people allocate money elsewhere, these things are kind of trading as a basket, so it would certainly negatively impact Amazon as well, I would think. Okay. But again, take a look at these names. Obviously, they're very different names. I hopped from Amazon to KVUE to ABBV to Chevron. I would argue several of Amazon's probably more of a growth name. The other three probably more value names. But I think all four have a very interesting risk-reward skew going forward, one that could potentially be favorable. And as I mentioned, I'll just mention again, I own all four of those myself on my own accounts. And we tend to own them for a number of clients at the book level as well. Hope that was helpful, everyone. We're still getting some earnings reports, so over the next week or two, we'll continue to fill you in, on what we're hearing from our favorites. Until then, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.